Всем привет.
Привет.
Приветствую.
Привет.
Так,
Привет.
проверка звука. Меня слышно?
Слышно.
Благодарю.
Так, сейчас я напишу от Адама. Адам. Эту ссылку теперь поширить, чтобы это было на английском языке. Добрый день, Шамиль. Доброе утро, то есть.
Добрый день, Рузат.
Как ваши дела?
Ничего, нормально, отстрелялся позавчера с Узбекистаном. Очень хорошую программу мы тоже сделали.
Да, я видела Узбекистан.
Да.
Hi, Ezgi. Nice to meet you.
Азги.
Hi, everyone.
Hi, Adam. Hi, Melissa.
We miss
Hey,
you.
guys, how
I
are you?
apologize.
Yeah, we miss you guys.
I miss you guys too. How you guys been?
Great.
Excellent.
Let's wait for a while. I think
Yes,
people are
that's
going to
fine.
join.
Sure.
Hello, everyone.
Good morning.
Good morning.
Hi, Christian.
Good morning, everyone.
Morning, Christian.
Good. I think we can start.
Okay, let's see. You want to wait for just a few more minutes, just in case?
Yeah,
Okay.
maybe 2 more minutes, yeah.
Yeah, that's fine.
How was the program with Uzbekistan? Shamil, did Material Impact also participate?
No, the workshop for Uzbekistan was designed for policymakers. You remember
okay.
that when we did the, you remember like my presentation in Kyrgyzstan when I did my research presentation, it was like MIT 5 stakeholders ecosystem concept. So what we're actually doing now, we have workshops for entrepreneurs, growth markets, early stage market, growth stage, early stage, and deep tech. That's for entrepreneurs. Now I designed the program for policymakers. And for Uzbekistan, it was a program for the government, for the Ministry of Digital Development and for IT Park. I think having something like this for Kyrgyzstan would be also great. But we need some political will and we need some funding for that. Yes,
Yeah.
that helps a lot to boost the whole ecosystem to ensure that all decision makers, all major stakeholders are landing on the same page. And Adam, there is a big request for a venture capital workshop from Kazakhstan, from Uzbekistan. People are like, okay, everything is great. We need to teach venture capitalists in the region how to build those business angel syndicates, what policies should be adopted, you know, like what are the general prerequisites, you know, for VC to thrive in a particular country or the region. So I will probably start working on a workshop that is designed for them. And I would really appreciate if we can also engage you and get your expertise on that. But first, I have to make sure that we have funding for that. Once we secure funding, I will get back to you to start working on the content of the workshop, if you are willing to contribute. You are muted, Adam.
Sorry, yeah, thank you. Happy to always discuss how we can be of help and our ability to contribute. So looking forward to that discussion, Shamil.
Great.
Okay, I
Great.
think we've now gone up to I think 21 people on the call. So I'm assuming we have. For some reason I don't see but 9. Maybe that's just a Teams thing. But I think we can go ahead and kick it off then. Let's see. Let me share a screen quickly. Here we go. Let's see if this works. I'm not sure if this is going to work. I've had sometimes issues with Teams before.
Yes, sorry for Teams. It's just
No worries.
we are using it HTTP Teams. I'm sorry for this.
No
I can see
worries.
your screen, Adam. Yeah, can see it.
Okay.
Yeah, me too.
But when I do that, then I lose, unfortunately, my visibility. But maybe I can present it if you don't mind from a.
You can just send it to me as well.
Oh, yeah.
No. Can I? I'm gonna present it in a way where I can see people as well. But I don't know how it is it showing up right now or no? Not yet.
No, not showing
No.
up, but Adam, you can email it to me if you want, or text it to me, and I can show the screen.
Okay. Is it showing up now or still not yet?
No. Mm-mm.
Good grief. Okay, 1 second. I may do that, but let me just, in the sake of being expedient, let me try one more time. Okay. Now can you see it?
Yeah.
Yes.
You can see it?
Yes.
Okay. But it's not in full presentation, right?
It's not in full presentation, but
Yeah,
you can
that's
press
fine.
that not full presentation button too if you want.
Okay. Well, I don't know where that button is, but I'll
I
just
think
keep
this is
going.
good enough.
All right.
Yeah, I think it's good enough.
Is it large enough for you guys to see?
Yeah, I can read it.
Yeah,
Okay.
me too.
All right, good. So look,
Same.
guys, excellent. I I want to make sure that we have, a good discussion today. It'll be, a free-flowing discussion. But it came out of, I think, the very tail end, the last day of our time together, as we were going through a few examples, it became apparent that maybe there needs to be a more uniform understanding amongst the team of kind of the basic mechanics of venture financing. And so put a few things together that may help illustrate at a high level the things that you as an entrepreneur need to understand about different vehicles of financing and the considerations that you have to have for each of those vehicles, the trade-offs, and the key terms that you need to think about for each of the three. So that's what we'll talk about today. I hope it'll be helpful, but also happy to field questions. It's a free-flowing discussion as we go. So let's see if I can do this one. Here we go. So, this part's pretty simple. The intent here is for capital to help companies grow through the various phases of their evolution, ultimately into some sort of exit event that allows for a return in invested capital. Now, there are some exceptions to that. Exception number one is that if you're a company that can run privately and then you can return invested capital through another means like dividends or profit sharing or so forth, things can be structured that way. But the traditional venture financing really pays off to the investor upon some sort of liquidity event, some sort of transaction in which the shares that they purchase then have value that they can sell. Okay, so let's start with that point. There are about three, I would say, we're gonna divide the discussion into three basic categories of venture financing. There are debt instruments on one end of the spectrum. There's equity on the other end of the spectrum. And the difference being that in debt, you're just basically taking a glorified loan. In equity, you're selling shares in your company. And then what sits in the middle is, what we call convertible instruments. So things that can convert debt into equity. So keep it very simple: debt, equity, and convertible from debt to equity. Those are the three basic categories of venture financing. All of them have, again, various places in terms of their utility that you should consider depending on your situation. And hopefully some of those situations will become more evident as we proceed. Really important to understand some of the critical elements of each and how they may impact your business. There is no one size fits all for anybody. How they may impact your situation and your business and the phase that you're growing your company. So let's first start with a high level. Okay, those three basic instruments. So debt instruments. When you have a debt instrument, by default, you're taking a loan, as I mentioned. So you don't really have any dilution. You're not selling shares in your company, so you have no dilution. However, you have to repay it at some point, okay? Because you're not selling anything. So you have to repay it. From the investor side, it can sometimes be lower risk because at the end of the day, the loan amounts have a lot of certainty in which they have to be paid back. So for the investor, it's really about how much money they can get back in terms of interest or other sorts of bells and whistles that allow their money to come back. And most importantly, this is the thing I want to make sure that there are certain things I'll highlight and say, make sure you take that away with you. Here's one of them. It sits senior on your capitalization table, i.e., they have to usually get paid first before anything else gets paid. So in any kind of event where you can sell, your company or so forth, before you get paid any money, before your other investors get paid any money, loans get paid first, or debt gets paid first. So that's the certainty of debt, which makes it a little bit lower risk. If you have to sell the assets, you have to sell whatever you have to sell, that has to get paid first, right? So that's the pros and cons of debt. No dilution, but it says senior on the cap table. We're going to jump right now to equity, and then I'll come back into the convertibles in a second. Equity is exactly kind of the opposite. You're immediately selling shares, so you have an ownership transfer. Now, this is an important concept, because I'm going to make a few editorial comments as we have our discussion today. It's funny how entrepreneurs will sometimes raise venture capital equity, but run it like it's their company. I want to make sure you understand this very simple, basic comment. Once you raise equity financing, it's not your company anymore. It's the shareholders' company. Okay? So you may sell, you may raise a blah, blah, blah round, and we can talk about what the percentages are. And that may end up having you own, 30%, 40%, 50% of your company. Keep in mind, that means the other 50, 60, or 70% is owned by other people. So just keep that in mind. It's an important mindset shift as how you approach decision-making. Obviously, there's no repayment obligation because you're selling the shares, but there's a dilution to you. But the more important comment that I want to asterisk on this one is it has board and governance implications because of what I said. It's no longer just your company. So there has to be a board that has to be in place once you raise an equity financing. And the board's point here is not to manage their own money. The board here is meant to ensure that all shareholders are represented. All shareholders. Not just you, not just the investors, all shareholders, okay, collectively. So there are governance implications on equity. Then we'll jump back to the middle bucket, convertibles. Okay. A convertible note basically says, okay, give me a loan today, give me some debt today, but it can convert into equity later. And you can specify when that can happen. Usually it happens when you raise another round of financing, equity financing. So it'll sit basically as debt, but the investor will have the right to convert it into equity upon the next round of financing, of equity financing. Okay? So it can convert, that's why it's called a convertible note. It can convert into equity. Okay? Effectively, what that does is it allows a more speedy way for an investor to put money into a company, to invest into a company without all the legal details of owning shares in the company. But it does have some terms that are going to be very important for us to discuss because they'll be investor-friendly terms that offset basically the speed at which they can do this. Those usually come in the form of what are called valuation caps and discounts, and we'll talk more about that in a second. So those are the three basic blocks of venture financing. You'll see the word safe that's written next to convertible note because all a safe is basically it's a kind of convertible note, but they've become very popular in the last 10 to 15 years. And the reason they're popular is the only major difference between a safe and a convertible note is that a safe is even more streamlined. Sometimes it can be a one-page document. Okay? So it's a convertible note that's even more streamlined. And the things that make it more streamlined is that it is not really a debt instrument per se. It has to convert into equity. It doesn't give the investor the right to call back the loan or to get the loan repaid as debt. It has to convert into equity. And so some of the terms will fall off and it makes it a bit of a simpler mechanism. But there are also less rights to that for both the investor and the founders. All right, so now let's talk about each of the different buckets, but let's go into more detail now on each of the terms. So debt financing, all right? So again, it's borrowed capital with interest. You usually have these types of instruments being given by banks, by different types of venture debt providers. And it can be done in ways where they get repaid through, principal and interest, or interest only for some time and then principal interest. Lots of different flavors and shapes and terms you can negotiate. And some of them can also be driven by how much the debt provider puts in will be a function of how much revenue you're making and how well you're tracking. So there are so many ways, there are so many dials that can be turned, but in general, it's a loan. So the major terms of a loan are usually interest rate, some sort of date by which the investor can call back the repayment of that loan, right? And then there's stuff that we're not going to get into today because it's a little too complicated, covenants and so forth. We won't deal with that. That shouldn't affect you guys in the earlier stages too much. Collateral, right? How the loan is secured. What assets are you willing to provide proof of that will be liquidated if need be to repay the loan if you're not able to repay it in cash. And then this thing called warrants, which we're going to get into a little bit later, okay? But warrants are effectively the right to purchase equity into a company at a pre-negotiated price today, independently of how valuable the company is tomorrow. That's the way you can think about warrants. So let me pause there before we now move to the more interesting stuff, because debt financing should not be one of the primary vehicles you guys are using to raise money. Although I do know that in the regions in which we're operating these days, outside of the US and Europe, there isn't a very well defined venture capital industry. And as such, debt financing is still sometimes one of the primary modes of raising capital. But I'm hopeful that you guys will not be raising too much debt financing, and we'll talk more about that in a second. So now let's talk about the convertible note option, right? This hybrid to be able to raise debt today that will convert into equity at some later date. The primary advantage of this is it doesn't require the negotiation of what the valuation of the company is. That usually is one of the biggest sticklers in equity financing, right? When you're selling shares in your company, somebody wants to put in $1 million into your company. How many shares they get depends on how you're valuing your company, right? So you'll determine basically the price per share. Basically, that it'll depend on how much your company is worth, the valuation, and how many shares you're going to be selling. So when you're not selling shares today, you don't have to worry about that valuation discussion. Okay. However, here are the things that do come into play. First one is what's called a valuation cap. What you can negotiate, or what the investor can negotiate, is to say, hey, we don't have to worry about trying to assess what the valuation of your company is today. But when it converts into equity, when somebody wants to raise or to invest equity into your company, and it then can convert into equity, then no matter what they're willing, no matter what that new investor is willing to price the company at, my shares will convert, my debt, will convert into shares at this pre-specified price. So let's take a moment to make sure we all understand what that means. So suppose you raise $1 million in convertible notes, okay? And one of the key terms is there a valuation cap? And so suppose the investor puts in a $3 million valuation cap. So it says, that's the value at which my $1 million will convert into your company. Okay. Later on, you're able to raise an equity round of financing in which the company is valued at 5 million. So now, theoretically, without a valuation cap, the $1 million the person invested before, the note investor, would convert into equity based on the company being worth 5 million. Okay, so independent of anybody else's money for a moment, that would almost be like 1 million on top of 5, right? Which means you're putting in 1 million, company was at 5, is now 6, so the note holder would have 1/6 of the company. Rough math, because we're not talking about other investors right now coming in. However, if they set the valuation cap to 3, what does that mean? That means they're saying that, well, whatever value you're raising your equity around, my note will convert at the value of 3. And so my 1 million will convert at the value of 3 million. So it'll be 1 on top of 3, so 1/4. So you know what? I own 25%. So you can see how big of a difference that can make. Instead of owning 16%, that they now all of a sudden own 25%. And so forth and so on. And it could make actually much bigger swings than that. So a valuation cap is one of the key terms that has to be negotiated. The next one is called a discount rate for the note. So let's keep the same example. I'm a person who's discussing and negotiating a note with you as the founder. And I say, again, I'm going to put $1 million into a note, and I have a discount rate of 20%. Okay. That basically means that when the equity round of financing occurs, if it's at a valuation of 5 million, right? My note would buy shares as if the company is worth 5 million. But since I have a 25% a 20% discount on that note, then basically it buys 1.2 times the number of shares it would have bought. So whatever the valuation was, I get 20% discount off of that. So the 5 becomes a 4 million. So I buy at basically the price of 4, not the price of 5. So that's what the discount rate is. Okay. Those are the two biggest dials that you have in negotiating a convertible note. There are other things like interest rate, which is pretty much fixed. People don't normally, I mean, it's usually ranges between 5 to 10%. Maturity date, when the note has to be dealt with, when it either converts or has to be paid back, that kind of stuff. So let me pause because I've said a lot, and I don't know, how many people. I may be talking to people who understand this like completely, and this is boring, and other people who, this may sound confusing. So let me pause and see if there are any questions that we can discuss. Is this clear as mud, guys? Okay, so Nur Sultan is giving me a thumbs up, but I can only see a few people. How about
clear so far, people?
Anybody have any questions, and does it make sense? And don't be afraid to ask a question. There's no such thing as a silly question here.
Yes, I have the question. What about your founding about cutting edge of science? I asking how a independent researcher.
By asking an independent researcher, what? I'm sorry, I didn't understand the question.
Oh, yes. I'm asking about, sorry, English is not my main language.
No worries.
Okay.
It's a lot better than my
I
Russian. Don't worry.
okay. I'm asking about mm, give me a second, please. I need a translator.
Take your time. Take your time.
Yeah, you can
Why don't you
text
take
in
your-
chat in Russian and I can translate. It's okay.
Yeah.
Please feel free to text in Russian in chat.
And while you're doing
Oh,
that,
sure. Okay,
does,
okay. Thank you.
does
I
anybody
will
have
write
any
in the
questions?
chat.
And let's keep the conversation, and we'll come back to you, Deutsch.
Yeah, we invited here not only MIT HCP like graduates, but other startup founders as well, just in case. And here's a question in the chat: like, what is the jurisdiction of where these agreements are made?
What is the? Sorry, say it again.
Jurisdiction of where these
Jurisdiction.
agreements are made.
Oh, that's a very good question. So, obviously, in general, it's going to be very much driven by where you think you're going to have the majority of your operations and so forth. In the United States, the grand majority of these types of agreements are registered in the state of Delaware, because Delaware law is very specific in terms of governance, and so the grand majority will recognize that and it makes investors from all around the U.S. more comfortable. However, we have in our own portfolio companies that are registered in either a different state or in a different country, and some of the documents are actually their jurisdiction is in that country or in that different state. It makes it more complicated sometimes for investors outside of that jurisdiction to feel comfortable. But it's a consideration. That is, if you think you're going to be raising a lot of capital in the U.S., for example, you likely will want to create some sort of entity, a legal entity in the U.S., and then have the documents go through the jurisdiction of Delaware, as an example. Any other questions?
Yes, I write my question in the chat. If someone can translate, it will be nice.
Yeah, I just it's a question. How ChatGPT is saying, how is the evaluation conducted for emerging scientific fields that do not yet have established peer reviewers? I don't know. This is kind of.
It means like more about the valuation of company, which is like mostly in deep tech. What kind of multipliers and I mean valuation cap is like be calculated in scientific deep tech companies.
Yeah, I hate not to be very specific. I'd like to try to be as specific as possible, but there's no single answer to your question, because you can have technologies that are, again, based in science, like you said, that are addressing one market versus a very different market. It's all about the size of the market. It's not about the kind of technology that it's addressing, and therefore, if the technology you're developing into a product is one that could generate tens of millions of revenue versus 100 millions of revenue versus 1 billion of revenue, then all of that will dictate valuation. It's not the kind of technology. Okay, let's anybody any other questions? Let's move on then if that's the case. So remember, we said safes are just a different kind, a specific kind of convertible note. The only thing I'm going to highlight here is that the safe doesn't give the conversion option for the investor. Okay, where a convertible note does. They can convert or they can ask to get repaid back in cash with the interest and so forth. And so a SAFE, it has to convert upon future equity. When it does that, it usually then doesn't have to have certain terms like interest rate and maturity date, because it's going to convert. That's the main point of a SAFE. And so the advantage is it can be a one-page document. It can be very simple legally. It can be put into place usually within days to a week, as opposed to longer negotiation for all the terms of a convertible note, and certainly sometimes weeks to months for the negotiation of an equity round of financing. So this is by far and away the most streamlined. There are still things like valuation caps and discount rates, because it's going to convert. So those things have to be negotiated, but it really becomes only those two as the major dials that have to be negotiated. Okay. I'm just for the sake of discussion, I'm gonna not worry right now about what are called MFN clauses and so forth. Happy to field questions about those in more detail later, but just to keep the conversation going and make sure we get the big picture. So a SAFE, a certain kind of, as a more streamlined version of a convertible note. So we talked about how a SAFE or a note converts into equity. I gave you an example of that, so we won't get into that. But basically, like I said before, it's really a function of what is the valuation cap, what is the discount, and any accrued interest, and that basically the value of the note then converts into equity depending on all of those things. So now we get into the main bucket, which is equity financing, right? When you're actually, which is the grand majority of venture capital is really focused on this, okay? Which again means that the investor is purchasing ownership into your company. So there's no repayment obligation, but you're selling part of your company. Now there's a lot of stuff to cover here. Invested capital purchases what is known as preferred stock. There are some exceptions that you can negotiate, but the grand majority of investors, when they purchase ownership into the company, they purchase preferred stock. You as a founder have what is called common stock. Okay, and the difference between the two is preferred stock has certain protective provisions, certain things that protect those shares of stock that are not applicable to common stock. Okay, those things can be in the form of that there needs to be a certain amount of approval by the majority of the preferred stock for major decisions to be made, which does not account for the common stock, because the preferred stock is coming from people who actually put money in. You as a founder have developed certain things on the technology, are running the company, but the shares that you own, you haven't put money in. Now, if you put money in, if you purchase shares, then you have the right to purchase preferred shares and be like an investor in your own company. And those shares that you purchased shares will have the same rights. They'll be preferred and have certain rights. But the shares that are issued to yourself when you found the company and you're raising capital at a certain valuation, the shares that you grant yourself, they're common stock. Okay, so number one, keep that in mind. Preferred stock is what is actually purchased by investors. The major terms that are to be negotiated in an equity round of financing is everything from valuation, which we talked about, right? So if you're raising $1 million on a $9 million valuation, your post money is $10 million. So your pre-money is what is the valuation before you raise the capital. The post-money is how much is your valuation after you raise the capital. And you can do some easy back of the envelope calculations to determine what ownership you will have and what ownership the investors will have. Okay. So the simple example of you're raising $1 million on a $9 million pre-money, just to keep numbers simple, means your post-money will be 1 plus 9 is 10. And it means that the invested capital will own 1/10 of the company, 10%. Okay. If you're raising $5 million on 5 million pre-money valuation, then the investors will own 5/10, right? 5 million that they're putting in on 10 million of the post-op, they'll own 50% of the company and you'll own 50%. Okay. So how much you raise at what valuation are the key drivers in terms of what the ownership will look like after the equity financing. So that's obviously very, very key. Second thing is that there's a term called liquidation preferences that we'll get into a little bit more in detail in a second. But a liquidation preference is the amount, the multiple of how much money the investors will get back first if you were able to sell your company. We'll get into that detail in a minute because it's an important one. So let's put an asterisk and come back to that. Okay. The next major thing that you have to negotiate are things that pertain to the board composition and the option pool. Okay. We won't talk about the other stuff because it's more minutia. But the board composition, we'll talk more about the pros and cons of what that looks like. And the option pool is basically saying, hey, if I'm selling shares in the company, we in effect should be also creating a pool of shares that allows me, the founder, to continue to do two things. One is to add shares to the founding team or to the early team who will now be diluted, because every time you raise equity financing, you as a founder and the team will get diluted. So when I gave you the example of raising 5 million on a 5 million pre, you're diluting yourself by 50%. You had 100% ownership, now you have 50%. And anybody who is with you on the team will have their ownership diluted by 50%. So sometimes try to soften that by saying, let's create a pool of options. They're not shares, they're options, which basically means that they have what's called a vesting period, which we'll talk about that in a second. And they're like a bonus. And basically you can use that to keep adding to the team, the core team members, so that it lessens the impact of dilution for financing rounds. It also becomes a pool you can draw upon to give ownership of the company to new employees, new team members that you're trying to recruit. They're going to be critical. If you're trying to recruit a new leadership team member who is a chief of operations or a chief of manufacturing or so forth, then you can use those shares to grant to the new team members to incentivize them for upside. Because usually as a startup, you cannot compete with a large corporate, obviously, in terms of salaries. So your biggest lever is to give them equity, to give people equity in your company, right? So that they have shares and they have ownership of the company as well, and they can appreciate upside. So those are the key things that you have to negotiate. Some of the key things that you consider when in these negotiations are to understand the trade-offs between control and capital. Okay. I'm going to pause here for a moment because this is really important. Remember, I told you that one of the biggest implications of raising equity financing is you have control provisions now, governance and control things that you have to consider. That is not the case usually with debt and convertible notes, because you're not selling any portion of your company away. But when you are, you now have to have a board, and you also have shareholders that are with you, where before you guys, as founders, really had the majority of the shares amongst you. And that means that the preferred shares, the shares that were purchased by investors, have certain rights that common shares do not. These are called protective provisions. And it basically allows the preferred shareholders, the investors, it gives them the ability and the right to be involved in decision making on major transactions. If you want to acquire certain, something, an asset or another company, or merge with another company, they have to approve. If you want to sell a portion of your company, they have to approve. Sell a portion of your company means raising funding. It doesn't just mean exits, because every time you raise funding, what are you doing? You're selling a portion of your company. So whenever you want to raise another round of financing, they have to approve, because all of these things will have an impact on their ownership. So they have to approve as a voting class. These control provisions are really important to consider and to think through. So even though I detail this stuff out in a later slide, let me actually get into this now so you understand. So we went through the example of you raised $5 million on a $5 million pre, your post is 10 million. So roughly speaking, the preferred own 50% and the common shares own 50%, roughly, okay? Now, the investors that are in the 50%, okay, the question now becomes, how many investors are in that 50%? Is it 1? Is it 2? Is it 3? Is it 4? And how is that broken up? Why is that important? Because in the control provisions, remember I said the preferred have the right to vote as their own class on major decisions like I mentioned, like selling part of your company or raising financing or so forth. They vote as one preferred bucket that can veto and stop you from doing something. Who's in that bucket is important, because how it's divided is important. So for example, if you have, now let's take a look at the preferred bucket. If one group owns more than 50% of the shares in just the preferred, so let's make sure we understand that. In the 5 million you raised, suppose that was one investor for 3 million, one investor for 1, one investor for 1. Right? That's 5 million that you raised. The investor that put in 3 million owns 3/10 of the company, right? 30% of the company. But they own 60% of the preferred shares. They own 3/5 of the preferred shares. So by owning 60% of the preferred shares, guess what? They and only they can approve. They have to approve every transaction that you do. So in essence, they have what's called a veto block. These are the kinds of things that you have to consider when you're not only talking about ownership and percentages of the total shares, even within the preferred shares, you have to understand, because they vote as a separate class, and as soon as you sell shares, they have protective provisions, they have the right to be able to veto certain decisions. And by allowing any one member to have more than 50% of the preferred, that one member has a veto on everything. Does that make sense? This is a very important thing that you got to think through. So guys, I'm talking to 24 people now, but I'm not hearing any questions. So it's making me wonder if I lost you or if it's all very basic to you.
Oh, yes, I have another questions. So suppose someone's research operates at the intersection of plasma dynamics and phase lock-in computation, something that doesn't yet you have a defined market, but could affect multiple industries later. How would you categorize that?
So Deutsch, I appreciate your questions, but I will tell you, I would have no problem in trying to maybe jump on a different call to answer your questions, because they're not necessarily pertaining to venture financing. There are different kinds of questions, like, you know, technologies and markets and things that we covered more in the workshops a few months ago. But I want to make sure, so forgive me, I want to make sure that I can answer your question, but I don't want to digress from the discussion that other people who have graduated from the program are coming to hear about, which is the venture financing piece. So if you don't mind, maybe Nourzat can I'm happy to have a discussion that's set up on the side to answer some of your questions.
There are a few questions in the chat, though, that do pertain to what you're talking about. So, and then also from Nikita. So one question is, what happens if the company doesn't plan a next funding round? Does the safe holder still get equity?
Excellent question. Let's talk about that. Excellent question. A safe or convertible note, like we talked about, is designed to convert into equity. If the company gets sold or there's some liquidity event, before that happens, there's a term in the safe agreement that defines what the value is to the investor in the safe. So, for example, it could be, if they don't define it, if an investor doesn't define it, you know what they do? They just get paid back, basically, with interest. But it's not much, right? From an investor perspective, that's they could have put their money in a bank. Okay, so a bank would have been a safer investment. But most savvy investors will think about that, and will have something like what's called a liquidation premium. So if the investor, if the company is sold before the safe converts into equity, they will get 2x liquidation premium, which basically means if they put in $200,000, they get $400,000 back. Okay. They still not their intent. When you go into a safe, your intent isn't to have a quick exit. You're trying to buy shares in the company for a longer term multiple. But at least you make it worth your while by having a liquidation premium. So one of the terms in a safe or convertible note is a liquidation premium. If the safe, if the company gets liquidated before the safe converts into equity. What's another question?
I want to be clear, though, if there's no next funding round, no priced round that occurs, the safe just sits there until the next priced round. So even if the company is not sold, it doesn't convert into equity unless there's a priced round. The next question, Adam, is, would you say that deep tech founders should prioritize strategic autonomy even over early growth? It's a great question.
Yeah, now you're talking about more of a philosophical question as opposed to a financing question. But in general, I will tell you, and we'll get into this again a little bit later. I know we're running out of time, but I always say that just thinking about the numbers is not the right way to raise a round of financing. It's important to look at all the things that I mentioned so far, which is, what are the control provisions? Who are the investors that you're bringing in? Of the amount of investors that you have, which ones are going to add value beyond dollars? Which ones are going to try to, which ones are aligned with your vision? If someone is trying to do a quick flip and make a strong IRR, but they don't care if it's a 1.5x or a 2x, they just want to flip it quickly, and you're trying to build a long-term company. If that investor has the majority of the preferred shares, they can stop you from raising another round of financing, and they can force you to sell the company at a much lower value. But then they win, they get their goal. You do not. Your work gets basically into, so that's important. And likewise, the opposite. If an investor is putting in money because their thesis is they want a 5x return, and you get an opportunity to sell your company for a 2x return, and you say that's fantastic, but that's not their investment thesis, it doesn't move the needle for them. They have a large fund, and that doesn't 2x on a few $1 million doesn't mean anything to them. Again, they can force you not to exit, because all of these are in the control provisions. They can force you if and only if they hold a veto. How do they hold a veto? If they own a lion's share of the preferred, or if. So all of these things, when you raise a round of financing, it's not that simple. You got to think through all these details. That's one of the lessons that I'm trying to make sure that we all have from this thing. And then I see one last question here. I see, when we're talking about shares, is it important to structure a cap table with common and preferred? The cap table will be, it's very unusual for an investor to put money in and buy common shares. Why would they do that? Now, there have been cases like that. I mean, there was a venture firm that tried to make their uniqueness based on the fact that they are founder friendly and they only buy common shares. That happened. That venture firm, which is here in Boston, by the way, did that for like 2 or 3 years, and they stopped because all the other investors that were also investing in those companies were getting preferred, and they were basically they got diluted very quickly, and they didn't have any rights, and and so that doesn't. It's very unusual. So whenever you raise venture capital, whenever you sell shares in your company, they will likely be preferred shares. So that's almost by definition. All right, we'll keep going because there's a few more things I want to make sure we talk about. I'm gonna jump.
I think you should reshare your screen because somebody took screen, I think,
sorry.
or something.
Sorry. Let's try that again.
Oh, it's okay.
Thank you for letting me know. Share. Can you see now?
Yeah. Thank you.
Okay. So let's talk about a few critical things, like liquidation preference. That's an important one. Okay. Remember when I told you that there is a term, one of the key terms in venture financing. Sorry, don't worry about my screen. I'm just trying to, as I'm talking here. There is one key term called liquidation preference. A liquidation preference basically determines the amount that the investor will get before the rest of the common shares get their money back. So if you raise venture financing, let's use the same example we've been saying. You raise 5 million on a 5 million pre. Okay? The customary way that is done is with what's called a 1x non-participating liquidation preference. I'll repeat that. 1x non-participating. Those are the two key terms. Now, let's talk about what 1x means and what non-participating means. 1x means that when you come to sell your company, the investors that put 5 million into your company, they get paid first. Okay? One time. So they get their 5 million first. So let's suppose you sell the company, your company, you sell it for 50 million. Okay? The investors will get paid first. Or they get paid the amount, the ownership amount of the total exit value. So they get to choose. I can either take 5 million first, or I can take how much I put in this case, 50%. I have ownership, 50% ownership, 50% of 50 million. Of course, in that case, they're going to take the second path, 50% of 50 million. So they get 25 million. Got it? But they have the choice. Suppose you sell your company for 3 million. Okay, it doesn't succeed and you sell for assets for 3 million. Well, in that case, they get the choice, 50% of 3 million, or they get their 5 million back first. Well, you don't have 5 million, but the first 3 million comes to them. So instead of taking 1.5 million, they'll take 3 million. But they get paid first. That's called 1x. If it was 2x, imagine the same thing I just said, but it's 2 times. So they get paid first, 2 times their initial investment first. So they put in 5, they get 10. The first 10 comes to them. They wouldn't make any different decision, right? If you sold your company for 50 million, they'll still take 50% of 50 as 25, right? But it changes the in-between cases. If your company gets sold for 12 million, if it gets sold for 8 million, then that's where these things make a difference. But they are given that choice. Usually you want to keep it at 1x. There are cases where you may not have a choice. You may only, your company is not doing well, and investors taking a lot of risk, and they demand a 2x or 1.5x or whatever. They demand something greater than 1x. So that's one dial that they have. The second dial is something that's pretty much gone away in the US, but it's coming back again. And that's called the participating feature. Okay, let me describe what that means. Participating means that the investor gets it both ways. They get both terms. They get their money back first, and then they also participate in the split, both, not one or the other. So let's talk about the math there. Okay, they have 5 million. They bought those shares when it was worth 5, so it's 5 on 10 as opposed, so they own 50%. You sell your company for 50 million, right? So the first 5 million comes to them directly first. That's how much they invested. How much is left? 45. 50 minus the 5 you paid them, right? Now there's 45 left. Now of the 45, they get half of that because they own 50% of the company. So they get 22.5. So they take 22.5 plus their first 5, and then the rest goes to the common. So in participating preferred, they get more money than just the 1x. So there's 1x or 2x or 3x or whatever, that's one. And then there's participating or non-participating. That's another dial. These kinds of things are under what's called liquidation preference. It's one of the key terms in an equity investment. You as an entrepreneur are always trying to negotiate to keep it simple and clean, which is 1x and non-participating. But if times are rough and you have no other options or they're taking a lot of risk, you have to understand that they could ask for those kinds of terms, and you have to understand what the implications of those are. I know we're out of time. We covered protective provisions. We covered the last thing. I'm going to cover one last thing, which is, the summary of a few things. All right, valuation. I'm going to start with that. Valuation. People always think as entrepreneurs, the higher your valuation that you can negotiate, the better. Okay, that is not the case. That is the case on paper. It seems like if you can negotiate a higher valuation, then you get less dilution. That's generally true, right? That's true. But what may happen is it may impact your ability to raise money in the future. And if you think that you need to raise multiple rounds of financing because you have a company to build before it becomes profitable and so forth, every time you have a valuation that's on the high end, you can deter new investors from coming in, because they look at the valuation of the previous round. They say, you know, the entrepreneur has expectations that are unreasonable, and it turns them off before they even start to really do their work and try to do diligence and so forth. You may think to yourself, no, really? I mean, they can always come back and negotiate a lower valuation. You got to trust me when I tell you, a lot of investors won't even look at the company if they just hear, what was the last valuation? And then they do their own math and they say, oh, no, we don't, that's too high for us. We don't invest in companies that are, you know, outside of this valuation range. Above that, that's a later stage venture firm, not for us. A lot of things won't even make it on the discussion once they hear that. So that's number one. Number two is it sets you up for a down round. A down round could be more dilutive than having diluted yourself a little bit more in the first round. Could be much more dilutive. And it sets a trajectory that's downward. It sets a stigma, a label with your company. Better to be a little bit more reasonable and more modest in your initial valuation, even if you're giving up a little more of the company, because then whatever slice you have, you grow that slice. That's your job, is to grow enterprise value and grow that slice. But try to take a bigger slice than you need initially, and that slice only goes down and the whole pie goes down. That's a downward trajectory. So just keep in mind, negotiating a higher valuation isn't always the best. You should negotiate a reasonable valuation, but it has to be reasonable. You have to have benchmarks and ideas of where, why. It's an art, as I talked about a couple of months ago, but it's not monotonic. It's not higher is better. So last thing I'm going to leave with you, and then we have to leave, is the following. There is a template, and I'll try to share this deck. And I think I put the link to the template in here somewhere. There it is. What's called the NVCA term sheet. Okay, this is a template for the National Venture Capital Association. They made a template that standardizes all the key terms. It would be very helpful for you to just read the template and almost imagine, go through an exercise where you're role playing, and you put in certain things into the template while you're preparing to raise a venture financing round, because it allows you to kind of model that out. What is it? Well, how would this impact me? How would this impact me? Get familiar with it now. Will serve you really well for when you're actually trying to raise financing later. Even if you're raising financing from local investors who don't follow the NVCA, you can use the NVCA to help you negotiate the right terms, even if you end up, not using the actual template. So a lot of the things that I covered today really are in, liquidation preference, valuation, control provisions. All those things are in the template. So I would advise you to download it. And finally, kind of the summary I want to leave you with is, every entrepreneur, you should really focus on when you're raising an equity round of financing, you should really focus on who the investors are that you're bringing to the table. I cannot stress that enough. Money is not money is not money. A dollar is not a dollar is not a dollar. You don't want to maximize the numbers and forget the qualitative, because when you're building an early stage venture in particular, you will be impacted more by who is with you and who gives you advice and who's willing to stand by you than by just the dollars they're putting in. Trust me. Okay. And I'll tell you, it's the same thing for investors, by the way. As an investor, I'll tell you, if you were to ask me what are some of the top 2 or 3 things that I've learned as an investor, no matter how good a technology is, no matter how big the market is that it's going to operate in, no matter how little the risk is that the company has in monetizing it, one of the biggest things that is a determinant of success is who's my partner, who's my entrepreneur that I'm investing in. What kind of person are they? Okay. Are they aligned with trying to build a company? Are they aligned with listening to advice? Are they aligned with trying to do the right thing? Man, that is huge. Makes a huge difference in success. Always remember that you balance also the numbers with the protective provisions and making sure that protective provisions and your operational freedom are balanced. And no matter how familiar you think you are with financing, always engage legal counsel. You will never, I mean, I've done now many deals over many years, and I would never dream of doing a deal without my counsel looking at it. Okay, no matter how quickly I want to move. There are certain things and terms and so forth that you may get from an investor, little fine print here or there, that could make the difference between, your company failing or succeeding. And the final thing is, your goal when you're raising financing is to build a long-term partnership to grow the enterprise value of your company. It is not merely a transaction. That said, thank you so much for your time and attention. I know I threw a lot at you. I'm hoping that it's useful and look forward to hearing success stories from all of you guys.
Yeah, here's the last question in the chat. I'm sorry for setting up just on 1 hour. I just wanted to be wiseful regarding your time. Last question. Valuation depends on the stage of the development of the company. How is a reasonable valuation determined? Is it better to already have initial sales, or does venture fund have the capacity to see the potential and help with financing to reach the point of sales?
Great question. It's very complex, and there's more art than there is science. In a late stage venture, it's much more science than art. In an early stage venture, it's more art than science. So what do I mean by that? When you're a late stage venture, which basically means that you're generating revenue for more than just pilot, you're at commercial scale, and you're now getting to a point where you've de-risked the aspect of product market fit. And you're now in the process of just scaling your commercial operations, your commercial activity. That becomes then a calculatable metric. You can look at, okay, what is your revenue ramp rate? What do I expect my revenue to be in years 2, 3, and 4? And you can look at a multiple of revenue depending on the sector. You can look at when do I think I'm going to be profitable, and you can use quantitative numbers to then set a valuation. An evaluation in terms of revenue, let's say you look at, year-on-year run rate of revenue, and you're already at a steady state. You could see, depending on the sector, you could see anything from a 2x revenue as your valuation to 20x, right? Depending on, again, the sector, okay, and the growth rate of that revenue, right? That's one metric. But if you're an early stage venture and you don't have that, it's all about, do I believe in the technology? Do I believe in the product market fit? Do I believe that the market is the right market? Do I believe in the entrepreneur? And it's a lot more of a hand-waving exercise. And the biggest quantitative aspect becomes what's called a benchmark. What have other companies? It's almost like real estate. The value of your property in your house has nothing to do with what you think and what the buyer thinks. It's what the market has said that kind of property in that location with that size usually gets. So benchmarks, the most quantitative metric you'll have. And in this market, benchmarks are low. Okay? It's a buyer's market right now. But unless you're in AI. So in any case, you basically have benchmarks and a lot of art on the front end, on the early stage. Once you're commercial and you say, oh, but now I'm commercial, but now I'm generating revenue, be careful, because now that you're there, you're going to be judged by that. And now you can be judged quantitatively. Then it is going to be a certain, quote unquote, multiple of revenue. Okay. All right, guys.
Thank you.
Thank you so much for your attention. Thanks for participating. And again, looking forward to hearing really great news from Norzat and from Shamil in the center, and hopefully from all of you directly on how well you guys are doing.
Thank you, Adam, and
Thank
the
you so
team.
Thank you, Adam.
Thank
Take
you.
care now.
Thank you
Cheers.
for your time, for
Anytime.
presentation. Thank you
I've
so
got
much.
one little small question. Can I?
Go ahead.
Go ahead, Nora. I'm running a little late, but
Yeah.
I'll try my best. Go ahead.
Yeah, I've got we've got not finished goal with the presentation. Do you remember us again, Christian?
No, remind me.
Great job.
What was the question?
What was the goal?
We should-
Sorry,
we should-
can you?
We should finish this point. Yeah, I'm just we'll just keep in touch on another meeting. So
Looking forward to it. Looking forward to it.
yeah.
All right. Take care, guys. Cheers.
Take
Bye,
care.
Nora.
Have a
Bye-bye.
great day.
Bye-bye.
Bye bye
Bye-bye.
bye.